Here's a number that should make you angry. The six largest banks in the United States collected $6.4 billion in overdraft fees in a single year. Not from hedge funds, not from corporations, from regular people who had $47 in their checking account when a $52 charge came through. That's the business model. That's the product. You are the product. But here's what nobody tells you. The moment you cross a specific savings threshold, the entire relationship between you and your bank quietly flips, and that threshold is lower than you think. My name is Joe, and I spend way too much time thinking about systems that are supposed to help people build wealth, but are actually designed to extract it. If you've ever wondered why saving feels like pushing uphill, while every product your bank offers seems designed to keep you just broke enough to stay dependent, hit subscribe, because what I'm about to show you is not theory, it's math, it's history, and it's happening to your account right now. The financial industry has a term called relationship value. It sounds warm and friendly. It is not. Relationship value is how much total profit a bank expects to extract from you over your lifetime. Overdraft fees, late payment penalties, credit card interest, monthly maintenance fees on accounts they marketed as free. When you have no savings, your relationship value is actually quite high, not because you're a good customer, because you're a vulnerable one. You're statistically more likely to overdraft, more likely to carry a credit card balance, more likely to take out a personal loan at 24% APR when your transmission blows up. Every financial emergency becomes a revenue event for your bank. But when you have $5,000 in a savings account, your behavior changes. Suddenly you have options, and options are the enemy of the fee model. Here's a concrete number. The Consumer Financial Protection Bureau found that households with less than 1 month of expenses saved paid an average of $900 per year in bank fees and short-term borrowing costs. Households with 3 months saved paid an average of $180. Same banks, same products, completely different relationship. That $720 gap is not an accident. That's the savings penalty. That's what financial vulnerability costs you on top of everything else. Now let me give you the historical parallel, because this pattern is much older than overdraft fees. Go back to the coal towns of Pennsylvania and West Virginia in the late 1800s. Mining companies paid their workers in company scrip instead of US dollars. Scrip only worked at the company store, where the company set the prices. Workers could never accumulate real savings because the currency they earned had no value outside the company's ecosystem. They couldn't leave. They were financially and psychologically trapped. The moment a worker got access to real dollars, the whole thing fell apart. They could buy elsewhere, they could save, they could walk away. Real currency was freedom. Scrip was control. Now look at your checking account. The overdraft fee is the company store. The ecosystem of fees is designed to keep money circulating inside the bank and never quite reaching the threshold where you start having options. The difference between now and then is that nobody is forcing you. The trap is psychological. It's marketed as convenience, but the mechanism is identical. So here is what $5,000 actually does to your life. Your car needs a $1,200 repair. With zero savings, that goes on a credit card at 22% interest. 6 months to pay it off, and the repair actually costs you $1,332. You paid an 11% premium for not having savings. With $5,000 in savings, you pay cash. Total cost, $1,200. Your savings made you money by not borrowing. Multiply that across every emergency over the next decade, and the math gets staggering. People with a consistent savings buffer pay less for everything. Their car insurance is lower because they can afford higher deductibles. Their negotiating position at work is stronger because they can actually afford to say no. Let me tell you about Maria. By age 28, she had $1,400 to her name, 2 maxed credit cards, and a car payment eating 18% of her take-home pay. She wasn't irresponsible. She was exactly the customer the banking system is optimized for. Her employer started an automatic emergency savings deduction, $150 per paycheck before she could spend it, into a separate account that required a 3-day transfer to access. Within 2 years, she had $5,400. Here's what changed. When her refrigerator died, she paid cash. She raised her car insurance deductible from $250 to $1,000, saving $60 a month on premiums. When her employer lowballed her at review time, she had 3 months of runway. So she said no. They came back $8,000 higher. Maria didn't get lucky, she just stopped being the person with no options. That shift was worth tens of thousands of dollars in 24 months. Now zoom out. According to Federal Reserve data, 37% of Americans can't cover a $400 unexpected expense without borrowing or selling something. Not $4,000, $400. And the payday loan industry collects over $9 billion in fees annually just on 2-week advances. Here's the economic structure. No savings means short-term borrowing. Short-term borrowing is the most profitable product in consumer finance. So from a pure incentive standpoint, an industry that profits from short-term borrowing benefits when people have no savings. I'm not saying there's a room somewhere where bankers are plotting to keep you broke. I'm saying you don't need a conspiracy when the incentives do the work on their own. There's one more thing nobody explains well enough. Savings doesn't just change your financial position, it changes your decision-making hardware. Researchers at Princeton and Harvard found that financial stress imposes a cognitive burden equivalent to losing 13 IQ points. That's the same as losing a full night of sleep every night indefinitely. $5,000 in savings doesn't make you smarter, it removes the noise that was making you operate as if you were impaired. Better decisions stack. Over a decade, marginally better decisions every month accumulate into dramatically different outcomes. So here are the actual steps. Action step 1. Open a savings account that is completely separate from your checking account and not accessible through your debit card. Friction is the point. If accessing the money requires logging into a different bank and waiting 3 days, you will access it far less often. A high-yield account at Ally, Marcus, or any online bank will do. Move $25 this week, just to open it, just to make it real. Action step 2. Automate a transfer the day after your paycheck hits, not from what's left at the end of the month, before you've absorbed it into spending. Start with $50 or $100. The number matters less than the mechanism. The mechanism removes the decision from your willpower budget entirely. Action step 3. Check what your bank is actually paying you. High-yield savings accounts are currently paying 4 to 5%. Most big bank savings accounts still pay 0.01%. That is not a typo. $5,000 at 4.5% is $225 a year for doing nothing. $5,000 at 0.01% is 50 cents. If you're below 3%, you are leaving real money on the table out of pure inertia, and your bank is absolutely counting on that inertia. Here's what I want you to take away. The financial system is not neutral. It generates more revenue from people with no savings than from people with savings. That's not a conspiracy, that's a business model. Understanding that model is the first step to opting out of being its product. The people who build real wealth don't start with some brilliant investment strategy. They start with a buffer, money sitting in a separate account, earning modest interest, doing nothing dramatic, but slowly converting them from a customer who has no choices into a person who does. That's what banks are afraid of, not your $5,000. They're afraid of what you become when you have it. The version of you that can say no, that doesn't need the overdraft protection plan, that walks away from a bad deal because walking away is actually an option now. That version of you is bad for their fee revenue, which makes it very, very good for you. Lazy investing built more fortune than crypto means, but before you can invest, you have to stop bleeding. The savings buffer is the bandage. Get it in place, make it automatic, make it boring, and watch what happens to every financial decision that comes after. Subscribe if this changed how you think about savings. Drop a comment telling me what your current buffer looks like. And if you're starting from zero, that's fine. Start from zero. Just start. I'll see you in the next video.